Hello, Kimball Creek partners and friends. Great to be back with you today. I'm excited about our topic. I'm here with Per Moerkeseth, who's a branch manager at the local Home Street Mortgage, part of Home Street Bank.
Yeah,
right?
absolutely.
He's been in the business for 21 years, and what I'm excited to talk about today, Per, is, as I mentioned earlier, a lot of our clients have trouble. They have a lot of net worth, they have a lot of assets, but because maybe they're retired or don't have that income that they did when they were a professional or had their own business, it's harder for them to get a mortgage. And so that's one of Per's specialties. So,
yeah. No, I feel like I run into this, quite a bit. Where again, it's either somebody newly retired or they've been retired for a while, or some that were able to, have set aside enough funds early on enough in their life that they're not even technically, quote unquote, of a retirement age, but they just have these assets that they live off of. And it's tricky because there's always, I feel like, been a disconnect on lending where personally you want to do everything you can to show the least amount of income. So that's IRS.
Exactly. Especially small business owners.
Yes.
Love to reduce their income,
Yep.
but when it comes to a mortgage, that's not always the easiest thing to do.
No. So yeah, I feel like an accountant's job and a lender's job are two different things. We want to show the most amount of income, and an accountant tries to reduce that, which is completely logical. So
tell me, if I have a client pair that, let's just pick a hypothetical, they have $10 million in an investment portfolio that's fairly liquid, but maybe they have $30,000 a year in Social Security or some nominal income.
Yep.
How does somebody like that who wants to go buy a vacation home or buy a second home, what are the steps? I mean, see you, right?
Absolutely.
That's great.
But
but what do you,
step one.
How do you help somebody like that?
Yeah, no, I'm glad you brought that up, because there's two main routes that I tend to go down in these situations, and sometimes it's dependent on age, sometimes it's dependent on how those assets are held. Are they in IRAs? Are they in just sort of traditional brokerage accounts? So non-qualified.
Yeah,
is the correct term on that, right?
Let's can we talk a little bit about that? So I'll narrow the scenario down. Let's say they have a $5 million IRA account, so a big retirement account, and maybe a couple of rentals and something that's not as liquid.
Yeah.
And they have, let's say, $3 or $4 million in just a taxable portfolio.
Yep.
So there you go.
And so often the IRAs are the easiest ones to use. Most investors will count those as assets, and we have two different routes when it comes to that. We can either have a temporary automatic distribution set up on the IRA, and so we kind of choose an amount that qualifies the client. And a lot of times too, where I use this is a client needs to buy before selling. And so then they're taking, they're debt free. They need to, they're going to go buy another $1 million, $2 million house. But in the meanwhile, they just want to try to put the least amount down, maybe do a jumbo loan, and knowing fully well that probably within 4, 5, 6 months, they're going to either pay that off or at least severely down to just a manageable dollar amount that makes sense for them. And so then we can set up a automatic distribution out of their IRA. The big key for that with most investors is it needs to have 3 years worth of continuance. So whatever dollar amount you choose to take out per month, so let's say it's $10,000 a month that we need extra in income on top of whatever we've been able to prove, well, we need to have an IRA or whatnot with at least $360,000 in it.
Okay.
So then that tends to be, for clients with 3, 4, 5 million in an IRA, that tends to be a lot easier to set up, because we can actually, and should it be that we need $20,000 a month or $30,000 a month to qualify, they can set that up. We get a letter that says, that confirms it's been set up. Some investors do want to see that first distribution already in.
Okay.
Some don't care at all. They just want that letter.
Okay. So let me jump in on that, because in that scenario, obviously taking a distribution from a regular IRA is going to be taxable.
Yep.
You're just saying that there needs to be enough money in the account, so theoretically you could continue that for at least 3 years.
Yep.
Correct?
But once you're closed on the transaction,
once you're closed, you could shut that off.
Yeah, we can't mandate that you keep that up. And so then I have some clients that cancel it, or have a lot of ones that they just ratchet it down just to where they need it to feel comfortable carrying this mortgage that they haven't been used to carrying, waiting for the other home to sell.
Okay.
And so then they could go, well, gosh, I only need really $5,000 and I'm pretty comfortable. And so then they can kind of ratchet that down, because we can't control what happens after that closing. And so if that route doesn't work as far as automatic distributions, we can do what's called I think it's called both like dissipation and or depletion of assets. Well, then we're just looking at the overall scenario. So let's say you have 4, 5, 10 million in an IRA. That becomes a really easy amount to use. So they have a calculation, and that is very much investor dependent. Some are more liberal than others as far as how much income you're getting, but it's not too difficult. So like on a 10 million portfolio, that's the same as 300,000 in income to some investors. To other investors, that's almost $500,000 in income. So then and then they don't need to do anything. They just
let me
need to,
clarify something,
yeah.
Per. So when you talk about investors, because remember,
Yep.
my clients are all investors.
Yes, sorry,
right?
yes.
You're
Oh,
talking about
gosh,
who's
yes.
buying the
Yep.
mortgage. So
Yep,
we're talking
thank
about,
you.
when we talk about investors, we're talking about you as the mortgage,
Yep.
what do we call you, the originator? Or
Yeah,
or
correct, yeah.
Your job is to find
Yep.
the mortgage investors who are going to end up purchasing that loan,
You got it. Yep.
and they're the ones funding it.
Yeah, because
ultimately to the
we'll
client.
process them, we'll underwrite them, get everything ready, but then typically they get shipped off to an investor that pools all these billions and billions of dollars worth of mortgages.
So this dissipation or depletion
Yeah.
method is somewhat determined by who's going to purchase that loan,
Correct.
and that's
Yep.
one of the things services you can provide.
Yep.
You kind of get to know where those different pools
Yeah,
are
and
and
if you
what the
need one that-
requirements.
yeah.
You might
Yep.
go here because they're more liberal or whatever, or better
Yep.
rates, whatever it is. But it's more than just a rate. It's
Yep.
getting them qualified in the right product.
Yeah, because
So-
if they're off by a quarter point in rate, but they're the ones that allow the most liberal amount per month that we really, really need, then that's just sort of the price to pay. And so, but two different avenues that both have this great way of, I kind of like the depletion of assets, the dissipation of assets, because it doesn't create
a taxable event.
Yeah.
Unless you're selling something at a gain. But
Yep, you got it. And there are some that have to take their their required minimum distributions, but they do it lump sum per year. So that's where I encourage. I'm like, well, rather than you waiting till December to do this, let's just set it up the equivalent amount, but we'll just set it up on a monthly basis. So then now they're going to take the same amount out as their RMD, but they're just going to do it monthly.
We get questions all the time when people should take their RMDs. So if someone were thinking about getting a mortgage maybe next year or the year after,
Yep.
does it help if they take that monthly and show that pattern of monthly distributions?
There's
on
very
RMD?
few that require a pattern. There's a couple of jumbo providers, so I'm glad you brought this up, that they want to see at least a 6-month history of having that set up, and then still that 36-month continuance. So if you're planning ahead, again, the earlier you meet on the mortgage side, the better, obviously. And so then you can map out, do I even need to do that? And if you don't, and all we need is a setup letter, then you can just hold
Great.
off and kind of do the same thing that you've always been doing. Yeah, but I'm glad you brought that up, because there's very few, again, again, this is where these buckets of what program do we need, what's the loan amount that you need, the loan versus loan to value, all these, and some will have different mandates. So the earlier that can be mapped out, the better.
Fantastic. Tell me, so just again, kind of changing gears, anything else you want to add? High net worth, lots of cash, what are
you
some
brought up,
tips and things that
when we were
would
chatting
make sense?
a little bit earlier, you mentioned clients may be looking to buy investment properties. And again, if they're not necessarily showing high income, because most of it's still held in their brokerage accounts, buying investment properties is also kind of a unique deal where if it's single family property, a duplex, triplex, fourplex, we can order a rental survey. And so we can have the appraiser not only value the home, see what that is, but they would also provide us a form that says, hey, based upon this neighborhood, this many bedrooms, it should rent out for XYZ. And then we can use 75% of that to offset the payment. So then qualifying for it tends to be kind of easy, because you might only qualify for taking on $200-300 more a month in debt, even though your mortgage payment might be $2,500, because because the rental survey said it should rent out for $2,700 or whatever. And we can use 75% of that. So that I've had a lot of success with, where you don't need to show enough income to qualify for the whole payment, because we know it's going to be a rental property. So that one's also kind of a good win.
No, I appreciate that flavor, because we do run into that fairly often.
Yeah.
Again, people have assets, and of course, those people who've been really cautious and paid off debt, and a lot of our clients have reduced their debt or eliminated a lot of their debt, sometimes all of it.
Yep.
it's hard for them to understand why they want to borrow $1 million. I have $5 million in this account.
Yep.
And I can't get a loan.
No, yeah.
it seems a little counterintuitive.
Yeah.
But I really appreciate that. Per, we appreciate you coming in. It's great to have you here. If you have questions, again, Per Moerkeseth, Home Street Bank here in Tacoma.
Yeah.
And he'll get you set up.
Yeah, anytime,
Great.
any kind of questions, I would be honored to be of assistance.
Thanks.
Thank you.